Hello and welcome to this week's Market Matters video update. My name's James Gerrish. I'm the lead portfolio manager at Market Matters and the primary author. Today we're going to run through November portfolio performance. So as is the case with every video at the start of the new month, we run through how the Market Matters portfolios have performed, the suite of Market Matters portfolios against what the market has been doing over that time period. So I think it's really important to keep abreast of how things are tracking. And it's also really important to have an underlying benchmark that you're tracking that against. So just to give you, a backdrop around what the market did over that period, it was a really strong month for global equities. So the MSCI World Index was up 4.67% over the course of the month. The S&P 500 over in the US advanced 5.38% in US dollar terms. Our market did better. So the S&P ASX 200 in accumulation terms was up 6.58%. So a really strong November played out here locally. That came on the back of a very strong October as well. So from a sector point of view, utilities were really strong in November. Origin Energy was bid for, and it's a really small sector. So they're up 20%, if you can believe that, but it's only a very small subset of the Australian market. The most dominant sector to really underpin the performance in November was the materials sector, which was up over 16% for the period. It's an influential sector from an index point of view. And obviously, we've seen a strong move into the commodity trade, which has suited the Market Matters portfolio positioning. One of the things that, from a broad macro perspective, that changed a little bit in November was rhetoric coming from central banks. So it seems now to us that central banks have potentially pivoted around rates, or at least they're going to reduce the aggressive nature of rate increases going forward. We've got signs that inflation is peaking. We've got signs that bond yields have peaked and are going to trend lower over time as economic growth starts to be impacted by this substantially tighter monetary policy that's been rolled out across the globe. So some changing dynamics from a macroeconomic point of view, but overall November was a positive one. In terms of the Market Matters portfolios, so looking at the flagship growth portfolio for the period, I'll just get the stats in front of me. So for the month of November, it was up 7.86%. So that was against the accumulation index, was up 6.58%. So a really strong month in terms of Market Matters growth portfolio. On a 1 year view, it's up 8.02%, and on a 3 year view, it's up 10.14%. So that's about 4% above market on a 3 year view. So that portfolio is going along reasonably well. Financial year to date, to the end of November, it's up 17 odd %. So again, the positioning around being overweight resources. We're also overweight technology on the back of our belief that bond yields peaking is going to instill some life in that part of the market. That really hasn't started to play out yet. So that's one area that really hasn't continued to, or hasn't moved in line with our view. Not everything moves in line with you view it in a particular time. That's yet to move. It's starting to show signs that technology stocks have bottomed, but we're not there yet. So in terms of the moves that we made in the portfolio, we had a position in Oz Minerals. We trimmed half of it into the first bid, and we've sold out of it into the second bid. So BHP increased their bid to 28.25 for Oz Minerals. We took the money off the table at about a 3% discount to that 28.25 level, just given the time frame that is likely to play out for that deal to complete. We also trimmed our positions in Woodside and IGO, I should say. It used to be called Independence Group, it's now IGO. We cut Aristocrat and Ramsay Health Care, and we bought back into Whitehaven Coal, and we bought James Hardie as well. So it was a reasonably active month in terms of our positioning in the flagship growth portfolio. The income portfolio put on 5.32% for the month. That was well above benchmark. Remember, this portfolio is around 60% exposed to equities and the balance exposed to property and hybrid fixed income type securities. So over a 3 year view, that portfolio has done 8.16% per annum, which is above its target benchmark, which is is 7% per annum. So that portfolio continues to perform well. It was a reasonably quiet month though in terms of our movements across that portfolio. We watched keenly with the takeover tussle, which we wrote about a lot between Perpetual, Pendal, and then a new entrant into that tussle was Regal, backed by an overseas fund as well. So it looks like Perpetual and Pendal are going to shack up together, and Pendal was the beneficiary throughout the month of that. So we're owners of Pendal, and that after a lot of volatility intra-month, we came out on the right side of that one at this stage. In terms of the emerging companies portfolio, on a 1 month view, that portfolio was up 5.76% versus Small Ords, which were up 4.92%. So a bit of outperformance. It's been a tough 12 months for that portfolio. It's down 18% on a 1 year view versus Small Ords, which are down 14, bit over 14% in terms of that. So underperformance on a 1 year view, but it has outperformed by a couple of percent per annum since that portfolio's inception. We did make some reasonably large changes across the emerging companies portfolio during the month. They're all detailed on the Market Matters website. Subscribers can log in and see exactly what we've done and the outcomes of those actions. But ultimately, we improve the quality of the portfolio, and we think it's got a better balance to take into consideration our views around what comes next. So the emerging companies portfolio to us is now positioned well for what comes next. In terms of the international equities portfolio, a tougher month. It was down 0.5%. Strength in the Aussie dollar has been the major headwind for that in the short term. It's benchmarked the MSCI World Index in Aussie dollar terms was up 2%, so a bit of underperformance in terms of that portfolio. If you look since inception, it's up 13.41% per annum. On a 3 year view, it's up 13.41% per annum, so well above the benchmark, and we're relatively comfortable with that portfolio. Our view around technology would help that portfolio. So if we do see money start to flow back more sustainably into technology, that high value growth area of the market on the back of bond yields peaking, then that's going to be a benefit, a support to the Market Matters international equities portfolio. All in all, though, November was a solid month for our portfolios. We're comfortable with how we're positioned at the moment. Just in the last couple of days, we've taken a little bit of cream off the top of some positions, increased cash across the portfolios to about 10%, so giving us a little bit more flexibility as we head into the back end of the year and early in 2023. Thanks for listening. Talk to you soon.